Joining us now to discuss all the details is the author of that note, Ben Swinburne, the head of U.S. Media Research at Morgan Stanley. Good to see you. So the two big questions for me are Disney Plus costs and theme park pricing. Have they got each of those things in the right balance, and that's why you think it can keep running?
Well, thanks for having me. I would say yes to both of those questions. On the cost side for Disney Plus, Disney's really been rationalizing their spending across the business over the last several years, really since Bob Iger came back as CEO. In fact, we've had real positive earnings revisions over the last 2 years, largely driven by lower than expected costs on the streaming front. So that's in a very good spot. And then on the theme park front, the way we look at it, post-COVID, there was just a surge in consumer spending, kind of revenge travel, all the things you know about. That had to be digested, which we think happened last year. And now we look at this and it's back to kind of a normalized trend line. So we think experiences segment growth can be the big growth driver for the earnings growth of overall Disney over the next couple of years.
Sarat, I know you own this one as well, so I got to try to push back a bit on the concept of pressure test your position here. With AI coming through, this is a big IP owner. It stands perhaps to get either taken advantage of or for the value of its assets to diminish. Why won't it?
Well, I think one of the things that has such original content that we've all grown up with generational, over time. And I think as the younger generations look at it and you kind of add to it, the cost of the goods, again, there is much lower than kind of creating new content for Disney. And I think combining all their streaming services and really focusing on the costs and growing kind of the streaming, I think that's going to add a lot of cash flow to a company that, during COVID had a really hard time just trying to meet the, they cut their dividend, et cetera. So I think that's going to be interesting. I think it's a cheap stock. There are two things that, concern me. One is what are they going to do with ESPN and how are we going to monetize that? And then the other one is the succession, who is going to take over? I know they're focused on that, and James Gorman is running that for their board. But that's going to be an interesting kind of next leg for the stock because it's come back. It's, it's not cheap. I think it's fairly valued, but it can compound. And if it has earnings growth, because it's one of those stocks that I think can do really well for the next few years.
Ben, I'd love to pick up on that point because that was exactly what I was going to ask. Bob Iger sort of has brought back some reassurance in that top seat at Disney. Who's going to replace him? It doesn't look like he's going to be there forever. And if you're an investor, what are you looking for?
Well, I'm not going to make a prediction on the next CEO right here, that's for sure. But I would say that we have tremendous confidence in the board and the succession committee. We think it's a real process. I think they're looking internally and externally. And as they've announced publicly, we should hear early 2026 who the next CEO is going to be. And so I think having visibility into the timeline is actually quite helpful for the marketplace. But there's a lot of talent on the bench at Disney, and we think there's lots of good options for the company to choose from.
What do you want them to do with ESPN, to Sarat's point? There's been so much discussion over this and really no resolutions at this point.
Yeah, so when we pitch Disney to try to simplify things, we talk about this being a theme park company that owns media assets, where it used to be a media company that owned theme park assets. And when we add streaming and parks together, you're getting an earnings contribution 60% plus and growing. So that's really what drives the business. Of course, ESPN is important. In fact, one of the things, you mentioned the lead-in Disney Plus turning 6 years old later this year. They're going to be bringing ESPN into the Disney Plus Hulu bundle in the next couple of weeks. In fact, when they report earnings on Wednesday, I think you may hear an official date for when ESPN will be sort of set free from the bundle for the first time ever. And you may hear from them a transaction with the NFL, which has been written about in the press, with the NFL taking an equity stake in ESPN. ESPN's about 15% of the earnings. So it matters, but it doesn't matter as much as it used to. But I think having the NFL as an investor, if that's what they actually announce, and then bringing ESPN fully into Disney Plus will give ESPN the best chance it can get in thriving in the new streaming world.
Sarat, I worry about the sports landscape in that I'm not a big sports guy. I don't watch ESPN or any of that. But the sports content I see is put out by the leagues on social media. That's where I see it, largely. So how much margin can you expect to get as a sports presentation, sports content brand if you're not the league itself and you're, in a way, competing with or cooperating in a league that wants its own margin.
And you are, but the key is live TV, live sports. That's where the ESPNs of the world make their money, or Major League Baseball or NFL Network. It's not the replays, the sports centers. It's that live action that people will pay money for, whether it's on Hulu for ABC or that's what you're going to look for. It's not just playing, hey, this happened last year. So people are going to pay for that, and that's where ESPN is going to have to make their money. Otherwise, it's this declining asset, which you're talking about. You're not going to pay for the growth.